Okay? So the statement of cash flows tells us this information. It provides us with this incredibly useful information. It tells us how much cash we received and paid during the period to operate our business, how much cash we've received or paid from investments that we've made, which are these more peripheral transactions. So here in the operation of the business, we're talking about how much cash we've received or paid on these sales or on these bills. When we talk about cash received or paid on our investments, we're talking about buying a building, selling a building, something like that. Okay? And it also tells us how much cash we received or paid in financing of the business, which would be like these loans that I use as an example. Okay, if you're taking out loans or repaying loans, issuing stock, paying dividends. These are all activities related to financing. So, as a result of this, as a result of the cash, because the cash flow statement tells us this information, it is split. And I say here it's reported in conjunction with the balance sheet and the income statement. But because it is split between telling us about operations, investing activities, and financing activities, does it make sense now why it's split into these three sections? Because they each have different important purposes. We need to know how much cash came in to operate our business. How much cash are we getting on these sales? How much cash are we paying on our expenses? We need to know how much cash are we paying or receiving to either sell off our investments. Is that what's making our cash balance high? Or are we investing in something which could be an indication of future growth, like we said? Or are we financing things? Which can also be a sign of growth or be a sign that we can't obtain we can't get enough cash elsewhere. So the cash flow statement is split into these three categories: operating, investing, and financing. OIF. O-I-F. OIF. That's the order. It always is in that order. Any questions so far on anything that I've talked about? Okay, so I'm starting with the basics. Again, none of this should be totally new. However, I want to make sure I start here to make sure that the cash flow statement makes sense to you as we delve into it, okay, rather than just starting with the mechanics. So, operating activities we're going to look at first. So the income statement includes, we know this, revenue earned and expenses incurred during the period. And I'm repeating this, regardless of whether cash was actually received or paid. Because on an accrual basis, do we care about cash received or paid? No. If we don't care about cash received or paid on an accrual basis, is it still important? Why again? Why might again it be important? Yeah, I mean, well, accrual is important, right? Because it's telling you what's actually right, what actually is earned or incurred during the period. But why is that not the big picture again? I've been saying this. I just want to make sure people are getting this. Why is that not the most important necessarily? Not maybe it's why are there other pieces that are important? I should say.
Like in terms of the other, like it's not as important. It's not as relevant because you don't actually have it. So like you could also might be predicting it wrong. You don't know necessarily.
Right. You don't know if you're going to get all of it. And can you, if you don't receive cash on your sales, can you pay your bills? And if you can't pay your bills, what happens? Right. Creditors are going to come after you, and you're going to not be able to continue to exist. So you need cash to be able to exist. So regardless of whether or not accrual basis tells us what we actually earned during the period, what we actually incurred during the period, that's all lovely. And it's all very important. However, without cash, you cannot exist. Right? Without having cash to pay your bills, you can't exist. You will become insolvent. So, whereas The income statement tells us what's earned or incurred. The operating section of the statement of cash flows tells us cash received or paid for the elements of the income statement. So some people would call this like the cash basis income statement. That's kind of like what the operating section looks like, particularly in the direct method, which we're going to talk about later. So it tells us cash received or paid for the elements of the income statement. So for example, Amazon Inc. sells goods to customers on account for $100 during the month of March. They incur $70 of expenses to operate. As of the end of the month, customers have paid $5 on their outstanding balances, and Amazon has paid $55 of their outstanding bills. So let's see what this looks like on an accrual basis. It's a little bit messy here. On an accrual basis, you have sales of 100, and you have expenses of 70 for a net income of 30. That's clear, yeah? Okay. In the cash flows from operating activities, wow, this is all a little messed up. You have cash received from customers of $5, this should say, and you have cash paid for operating expenses of $55, showing net cash flows from operations of negative $50. So this is an accrual basis income statement. This is the corresponding statement of cash flows in the operating section. Okay? So here, Amazon has positive net income, but they have negative cash flow from operations. So if you were just looking at this, what do you see? They did really well. They exceeded their expenses. Well, they did really well, whatever. In a simple world, they did well. They made more money than they spent. When you look at it from this perspective, what do you see? They're not taking in enough money to cover their bills. Okay? So you need to look at these two in conjunction with each other to really get a good full picture of what's happening with the company. Okay? Now, investing activities. Companies, I gave you buying or selling a building as an example. So companies may invest in assets. I gave you a building as an example, but they can also invest in stock of another company. Okay? So I gave the example in class before of Amazon can make an investment in Yahoo. Right? If you're a company, you can make an investment in another company. Or alternatively, they can sell these assets during the period. These are called cash flow from investing activities on the statement of cash flows. They involve changes in non-current assets. This is very important. So whereas the operating section, we're talking about changes in net income. We're looking at elements of the income statement. And we should say also current assets and liabilities. Cash flows from investing really involve changes in non-current assets. So I have here cash inflows in the investing section. If you sell property, plant, and equipment, what kind of asset is property, plant, and equipment? Non-current. If you sell investments, what are those generally? Non-current, unless they're short-term. If you are collecting on loans, you're generally talking about something non-current. They're generally non-current assets. Cash outflows. If you, instead of selling, you could be purchasing property, plant, and equipment, purchasing investments, or lending to others. Okay, so they generally involve changes in non-current assets. And I've already said, I don't know what it's doing there, these transactions provide clues to what the company's future plans may be. So by investing, I say buying new land or a new building can indicate the company plans to expand. We got there already. So operating, we're generally looking at elements of the income statement. Investing, we're looking at non-current assets. Give you an example. Oh, sorry. Okay. So I'm going to go through an example shortly of the investing section, then we'll go through the financing. Okay, can I move on? Okay. So for example, Amazon Inc. purchased land for $500,000 in common stock of Google for $25,000 during the month of March. So where would that land generally end up? You purchase land for $500,000 on your balance sheet, right? So PP&E is a non-current assets on your balance sheet. If you purchase stock of Google for $25,000 during the month, generally, where would that go? Investments, non-current assets. So here you are, you have this stuff on your balance sheet. These items end up on your statement of cash flows. Again, this is just, I don't know why this got messed up. Purchase of land, cash flows from investing activities. Purchase of land, negative $500,000. It should be here. Investment in securities, negative $25,000. For net cash flow from investing activities of negative $525,000 during the month. Okay? And I've already said this. Note that they involve changes in non-current assets. Financing. When companies make investments, they need money to pay for them. So sometimes these investments are paid for with external funding. So you might take out a loan, you might issue stock. So cash flows from financing activities involve changes in non-current liabilities and stockholders' equity. So changes in non-current liabilities and stockholders' equity are going to be shown in the financing section of the statement of cash flows. So again, you make investments in that new building. If you need a way to pay for it, you may take out a loan, you may issue stock. So those types of things, non-current liabilities, changes in non-current liabilities, and in stockholders' equity, end up on the statement in the financing section of the statement of cash flows. So I have here cash inflows will be from borrowing or issuing stock. And cash outflows would be repaying debt, excluding interest, purchasing treasury stock, or paying dividends. Those will end up in the financing section. Interest expense would end up on the operating section. Right? It's part of your income statement, it's an element of the income statement. The financing is the debt itself. The interest is you incur it in the course of operating your business. So it would end up in the operating section. This is like you're thinking here like the principal. Okay? So let's look at an example. So to pay for the $500,000 purchase of land, Amazon took out a loan of $200,000 from U.S. Bank and issued common stock for $300,000. So in the cash flow from financing activities, issuance of common stock $300,000, loan proceeds $200,000, net cash flow from financing activities $500,000. So again, just to reiterate, the financing activities involve changes in long-term liabilities and stockholders' equity. So if I ask you what would be found in the investing section, what are you thinking about? Non-current assets, right? If I ask you what's included in the operating section, what are you thinking about? Elements of the income statement, and I should also say current assets and current liabilities, because they have to go somewhere too, okay? That depends, and you'll see why that is in a little while. Because those are related to the income statement. And if I ask you about financing, now you're thinking about long-term liabilities and stockholders' equity. But intuitively, what I think will get you here to understand this, or to get you to be able to do a statement of cash flows and get it, is understanding why it's split up and what each different element of the statement of cash flows tells us. Okay? So if I'm interested in seeing if this is a company that's growing, which sections of the statement of cash flows am I more likely to be interested in? Investing and financing, yeah. If I'm looking at whether or not this company is able to continue to exist and as a profitable business, you're looking really more at the operating section. Okay, so depending upon what you want to know will impact which statement of the section of the statement of cash flows you're more interested in looking at. Okay. So if you were to take these three pieces in total that we just went through and create a statement of cash flows, so you just take the stuff we did with operating, cash received from customers 5, cash paid for operating negative 55, gives us cash flows from operating activities of negative $50. Cash flows from investing, we have our purchase of land and our investment in securities. We have net cash flows from investing of negative $525. And cash flows from financing, issuance of common stock, loans proceeds, gives you our net cash flows from investing of $500,000. So our net decrease in cash is negative $25,050. If our cash balance on March 1st was $100,000, then our cash balance on March 31st would be $74,950. So what should this number tie back to? Cash on the balance sheet. This should be cash on the balance sheet at the end of the period. Okay? It's kind of like a roll forward of cash from the beginning of one period to the end of that period. Okay? Any questions on what I've gone over so far? Okay. So there's one more piece I want to go through before we start to get into any exercises with this.